Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
All right, we've got 5 major stories for you today. We'll start in Germany, which is spending billions to pivot its economy from cars to defense. And that includes developing biohybrid spy cockroaches for the battlefield. Then we'll break down how security platform Vanta just hit a massive $4.15 billion valuation with a new AI that promises to complete security reviews 81% faster. After that, we look at General Motors, which is investing $4 billion into flexible factories, calling Tesla's all-in EV strategy a huge weakness in a volatile market. From there, we'll see financial giants Goldman Sachs and BNY Mellon teaming up to turn traditional money market funds into digital tokens on a private blockchain. And finally, we'll cover how UK regulators are taking direct aim at Apple and Google's 99% mobile market share, threatening to force big changes like allowing alternative app stores on the iPhone. The story begins with a decision that might sound like science fiction, but is very real. Germany is developing battle-ready spy cockroaches. These are cyborg insects equipped with miniature cameras and controlled by electrical stimuli designed to provide surveillance in hostile territory. Now, these aren't just tiny robots that look like bugs. Researchers call them biohybrid systems, and they are controlled by networks of actual living neurons. This fusion of a living organism with a machine raises huge ethical questions, blurring the very line between a living being and a weapon. It's a profound step that forces us to ask how international laws of war designed for traditional combat can even apply to this kind of technology. And these cyborg insects are just one piece of a much larger multi-billion-dollar pivot. Germany, a nation defined for decades by post-war pacifism, is now in a frantic race to reinvent warfare. The government plans to nearly triple its regular defense budget to a staggering 162 billion euros per year by 2029. This is part of a seismic shift. For the first time in decades, Europe is projected to spend more on new defense technology than the United States. However, if you zoom out, you'll see another layer of strategy at play. This isn't just about buying more tanks from the usual suspects. Berlin is slashing red tape to funnel cash and contracts directly to a new wave of agile tech startups. These smaller firms, developing everything from AI-powered robots to unmanned mini-submarines, are now advising the government right alongside the established giants. The co-founder of Helsing, Europe's most valuable defense startup, said it plainly: "We want to help give Europe its spine back." This matters because Europe's defense industry has been incredibly fragmented. As a comparison, the European Union currently operates 178 different major weapon systems, while the United States has only 30. This duplication makes everything more expensive and less efficient. So when he says give Europe its spine back, he's talking about overcoming this deep-seated fragmentation to build a unified, powerful defense capability. According to one CEO, the German defense minister told him directly, "Money is no longer an excuse. It's there now." The money is pouring in. Venture capital funding for European defense tech has already surpassed $1 billion this year, a massive jump from just $373 million in 2022. What's often missed in this conversation is the philosophy behind venture capital, famous for its move fast and break things approach. While that's great for a social media app, national defense requires strategic patience and absolute reliability. The big question is whether a system driven by investor returns can truly align with a nation's security needs, or if it will prioritize quick, profitable technologies over what's strategically essential. At the heart of it all is Germany. Its defense startups have received $1.4 billion in the last 5 years, more than any other European country. The head of the Armed Forces Procurement Agency says these new technologies are as revolutionary to the battlefield as the introduction of the machine gun or the airplane. Because of Germany's unique history, it's being incredibly careful about the rules for these new AI-powered weapons. In fact, Germany is pushing for a global ban on fully autonomous killer robots that operate without any human control. They are advocating for strict ethical guardrails where a human is always in the loop, a position that might even create friction with NATO allies who are pushing ahead faster. As Germany's famed automotive industry faces a slowdown, one defense startup CEO says he now receives 3 to 5 job applications a day from auto workers. This isn't just about jobs, it's a pivot for Germany's legendary manufacturing backbone, the Mittelstand. These are the small and medium-sized family-owned companies that have powered the German economy for a century. Now, historic engine makers like Deutz are retooling to build hybrid tank engines. The brains that once built the world's most famous cars are now building its most advanced weapons. We were just talking about Germany pouring public money into defense tech startups. Well, on the private side, the money is flowing just as fast, especially in cybersecurity. And let's start with a single statistic that might just change your entire perspective on this market. One company's value just exploded by 69% in a single year, jumping to a staggering $4.15 billion valuation. This isn't random growth. It's happening in the red-hot governance, risk, and compliance software sector, a market projected to nearly double to over $9 billion by 2029. To put that valuation in context, Vanta's main competitor, Drata, was valued at $2 billion. So Vanta is commanding a serious premium. The company is Vanta, an online security platform, and they just closed a $150 million funding round as cyber attacks intensify, hitting giants like Microsoft and Mark Spencer. So what's behind this meteoric rise? In a word, AI. Their platform claims its newly launched AI agent helps corporate teams complete complex security reviews 81% faster. So the thing is, this AI isn't just a fancy script. It's designed to automate the incredibly tedious work of security compliance. It autonomously digs through policy documents, evaluates evidence for audits, and even answers complex security questionnaires. This is what makes it so fast. But of course, delegating this to an AI means you have to watch for things like false negatives, where the AI misses a real vulnerability. Human oversight remains absolutely critical to validate the AI's work. An improvement of that magnitude is a complete game changer for companies drowning in compliance requirements. This is where the situation takes a more complex turn, especially when you see who's writing the checks. We're talking about industry titans like Goldman Sachs, JP Morgan, and cybersecurity firm CrowdStrike all getting in on the action. And now, get this, Atlassian, one of Vanta's own customers, is now also an investor. You know, when a major customer and an industry leader like CrowdStrike invest, it creates what experts call a halo effect. It doesn't just give Vanta money, it gives them immense credibility and market access. This can create a kingmaker dynamic where startups backed by industry giants have a massive advantage, potentially making it harder for independent innovators to compete. They aren't just using the product, they are betting millions on its future. As the lead investor from Wellington Management put it, Vanta's platform is moving beyond the standard for security, providing real-time, continuous verification that's essential for every industry. Interestingly enough, serving over 12,000 clients in 58 countries is incredibly complex. Each country has its own rules, like Europe's GDPR versus China's data laws. Vanta's platform has to act as a de facto interpreter of global law, using its AI to navigate conflicting regulations in real time. This is a huge technical challenge, and it raises the stakes for accuracy. Because if the AI gets it wrong, the consequences could be massive. The question is no longer if AI will reshape cybersecurity, but who will be left behind. Speaking of major players making big bets, an old giant is taking a direct shot at a new one. General Motors is now claiming Tesla's greatest strength is actually a massive weakness. On a recent earnings call, GM's CFO, while giving a hats off to Tesla, said their famous simplicity leaves them, quote, overexposed to a demand set that has been highly volatile. What we're seeing is a clash of two fundamentally different manufacturing philosophies. Tesla's gigafactories are built for one thing, making EVs as efficiently as possible. Reports show they can build a car in as little as 10 hours. They are all in, which gives them incredible speed and lower costs. GM's countermove is what they call an inherent advantage. While Tesla is all in on electric, GM is investing $4 billion to build flexibility into its plants, allowing them to switch between gas and electric cars on the fly. This investment is centered around their Ultium platform. Think of it like high-tech Lego bricks. They use modular battery packs and common electronics that can be rearranged to fit anything from a sedan to a big truck. Believe it or not, building gas and electric cars on the same line can be incredibly inefficient. It's like a kitchen designed to cook both gourmet French cuisine and fast food burgers at the same time. You can do it, but you might not be the best at either. If EV demand drops, they just build more gas-powered trucks and SUVs. The timing for this strategy could be critical, as the entire EV market is hitting a wall. Sales of new electric vehicles just dropped 6.3% year over year. Even Tesla is feeling it, with vehicle deliveries plummeting 14% for a second straight quarterly decrease. What really brought this to a head was a proposal from Donald Trump to end the popular $7,500 federal tax credit for new EVs. And these subsidies aren't just a nice bonus. For many, they are the deciding factor. One survey found that a staggering 45% of recent EV buyers said they would not have purchased their vehicle without the tax credit. We even have a real-world test case. When Germany recently scrapped its EV subsidies, sales plunged by over 27%. This shows just how fragile the market could be without government support. Analysts are now predicting record EV sales in the next quarter as buyers rush in, followed by a potential market collapse. This sets the stage for an epic showdown, but the numbers provide a crucial reality check. While GM is talking tough, Tesla still delivered 384,000 vehicles last quarter. GM's EV sales? Just 46,300? In fact, EVs make up a tiny fraction of the nearly 1 million total vehicles GM sold. The definition of winning here is starting to change. It's not just about who sells the most cars anymore. Tesla is increasingly positioning itself as an AI and software company with its full self-driving system already generating billions in revenue. They are betting that the real money is in the technology that powers the car, not just the car itself. So while GM is focused on winning the factory floor war, Tesla is trying to win the war for the car's brain. So the billion-dollar question is this: in a brutal, shrinking market, is GM's flexibility a genius move to weather the storm, or is Tesla's all-or-nothing bet the only real path to owning the future? We were just talking about a head-to-head clash in the auto industry. Now, let's shift to a completely different dynamic. A seemingly impossible collaboration on Wall Street became a reality yesterday. Two of the biggest titans, Goldman Sachs and BNY Mellon, have joined forces. They are turning traditional money market funds, one of the most stable parts of the investment world, into digital tokens that live on a blockchain. Now, it's crucial to understand this isn't happening on a public blockchain like Bitcoin or Ethereum. No, this system runs on Goldman's own private permissioned blockchain. Think of it like a walled garden. That's a huge trade-off. They get more control and higher speeds, but they sacrifice the core idea of decentralization that got everyone so excited about blockchain in the first place. This isn't just a tech experiment. It's a direct move to modernize the very infrastructure that underpins finance, making trading faster and radically reducing settlement times. This decision brings both incredible speed and comes with inherent risks. Experts from institutions like the Bank of England are raising a critical question: could this new efficiency paradoxically make the system more fragile? In a market panic, if trades settle almost instantly, a financial crisis could spread like wildfire, with contagion jumping from institution to institution in minutes, not days. And if that was just the appetizer, the main course is just being served. This isn't just a two-player game. Heavy hitters like BlackRock, Fidelity Investments, and Federated Hermes are already on board for the initial rollout. When names like these all move at once, it's not an experiment, it's a seismic shift. This rush to innovate creates its own challenge: interoperability. With Goldman building its system and competitors like JP Morgan building their own, there's a real danger of creating digital islands that can't talk to each other. We're already seeing efforts like the Canton Network, a consortium of major firms trying to build bridges between these private blockchains so they can all work together seamlessly. For years, tokenization has been a hot topic. Now, the debate seems to be ending as the most powerful institutions on the planet are placing their bets. This is Wall Street bringing blockchain technology into the heart of its own operations. After all, when you make a system this efficient, someone's job becomes obsolete. For decades, entire departments like clearinghouses and custodians have made their money managing the slow, complex process of settling trades. With tokenization, many of those back office functions could be automated away, representing a fundamental disruption to the financial workforce itself. This all begs the question: as the old guard of finance adopts the tools of its disruptors, who will ultimately write the rules for the future of money? It's fascinating. We just saw Wall Street giants using new tech to centralize their power. At the same time, regulators in the UK are doing the exact opposite, trying to break up the power of the tech giants that control the phone in your pocket. Britain's Competition and Markets Authority just proposed branding both Apple and Google with a strategic market status. That's a powerful designation, allowing regulators to force them to change how they do business the numbers show why. In the UK, Google's Android and Apple's iOS control a combined market share of over 99%. It's an absolute duopoly. Their control goes way beyond just selling phones. They control the operating system, the hardware, the browser, and most importantly, the single gateway for all software, the App Store. It's a completely closed loop. The regulator is targeting the core of their power, having heard from businesses about inconsistent app reviews, search rankings that may favor their own apps, and of course, that infamous up to 30% commission. That 30% fee has been a massive point of contention for years. While some developers promise to pass savings on to you if the fee is cut, the reality is more complex. Many larger publishers might just absorb the savings as pure profit. Regarding those app reviews, reports suggest Apple's human reviewers have to check between 50 and 100 apps per day. With quotas like that, it helps explain developer frustration when legitimate apps get rejected for minor issues while scam apps sometimes slip through. Here's where it gets interesting. The regulator is demanding immediate changes, like forcing Apple to be more transparent about app rejections and making it easier for developers to steer you to cheaper payment options outside the app. But that's not the whole picture. The real turning point is what they're exploring for next year, officially considering whether to force Apple to allow alternative app stores on the iPhone and even permit sideloading. This points to the start of what some are calling a regulatory splinternet. The European Union already forced similar changes on Apple, which the company implemented using geofencing. That means an iPhone in the EU has different capabilities than one in the US. The UK's move suggests your phone's core functions could soon depend entirely on your geographic location. So how did the tech giants react? They came out swinging. Google called the move disappointing and unwarranted. But Apple's statement was an absolute bombshell. They said the proposals would undermine the privacy and security protections that our users have come to expect and, quote, force us to give away our technology for free to foreign competitors. The situation presents a fascinating duality. On one side, Apple's claim about security isn't wrong. Research shows that Android phones, which allow sideloading, have anywhere from 15 to 47 times more malware infections than iPhones. On the other side, critics argue this security argument is also a convenient way to protect a very profitable monopoly. This sets up a massive battle. On one side, a regulator trying to break open a closed system. On the other, two of the world's most powerful companies claiming it will wreck security and innovation. The question is, who's going to win control over the device you use every single day?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.